dollar dominance is here to stay, folks. And I know that undermines or upsets some people in the audience because they think that the U.S. is horribly mismanaged. That may be the case, but when you're the world's reserve currency, you're afforded certain privileges that don't necessarily fit into a neat little box.
Well, and here's the thing.
That's a nice way to say it. It's more like when you're the reserve's currency, everyone's your
I drink your milkshake, and you cannot stop me. It's Wednesday, September 27th, 2023. This is Overtime. I'm your host, Chris Vecchio, joined by Ilya Spivak, and of course, Dylan Ratigan. Gentlemen, how was your day?
I thought we were spelling things at the top of the show.
No, but now I'm trying to figure out whether this milkshake thing is like a threat.
Yeah.
He was like,
It is.
He's like, listen, if you've got a milkshake, I'm drinking that thing.
Hey, listen, it's an oil day. Why wouldn't I quote "There Will Be Blood" at the top of the show? I consider myself a modern-day Daniel Plainview.
Listen, so I'm on edge. I'm feeling a little defensive, a little guarded, because I want to protect my own milkshake around here. But yeah, I mean, listen, it's a time. I've been thinking about this whole 1906 thing, this labor thing, this rate thing, the Ackman thing. When I say that, what I mean is like evidence of labor strength at a level that's not been seen in decades, or evidence of at least expectations of higher for longer rates, which has not been the case. Again, multi-decade shift. Antitrust activity, little FT, even if it's misguided, in my opinion, that's structurally whatever, but still it exists, right? You have a little antitrust action. You have a little strong labor action or sort of coherent sort of labor stakeholder tightness. And you have higher, longer money, and you have trending higher oil. I don't, that's less, the visibility to the future is always, vague, but.
Maybe the 1970s redux around here, although
or
1906,
as a friend of mine once said.
Well, these markets today, they face a little bit of some headwinds over the course of the session. It felt like deja vu this morning. We wake up, bond prices are higher, stock market's a little bit higher. All of a sudden, the U.S. session comes into play, and bonds, they go down across the curve, once again, led by the long end. Stocks actually do squeak out a modestly positive performance in the session, led higher by the Russell 2000, 1.07% higher here. That's RTYZ3. The December expiry, 1796.9. S&P 500, 0.14% higher, 4321. NASDAQ up by 0.37%, 14,000.
I mean, that's unchanged. That's unchanged. I mean, come on.
It's effectively unchanged. And so is the Dow Jones, off by 0.1%, 33,841. But gentlemen, the big mover on today is black gold. It's oil. So a few things here about this market. First off, oil prices finally break out. And if you're looking at X3 or if you're looking at Z3, you're going to get slightly different figures. But we are kind of coming into the area where that 100% Fibonacci extension that we've been talking about for quite some time is finally being reached. So oil price rally, completing this technical move to the upside. I love to hear it. Top performers by sector today are OIH up 3.04%, XOP up 2.96%, IYE 2.51%, XLE 2.49%. So Ilya, as you know, as someone who's been long energy here for the past 2 months now, this is a very good day and makes me feel much better about what's otherwise been a pretty crummy September for holding on to things like SMH and Apple and Amazon. The news today, though, is that the tank bottoms are being reached in Cushing, Oklahoma. Cushing, Oklahoma is a key choke point for WTI inventories here in the United States. We're now at some of the lowest levels that we've seen over the past decade. Not only do we see production cuts abroad, but the inventories we have here at home are fairly weak. So, Dylan, I want to start with you because this is definitely a political question. Was the Biden administration's decision to draw down the SPRs the right thing to do? Because now the SPR, the Strategic Petroleum Reserve, is now at levels that we haven't seen since the 1980s.
Yeah, I mean, listen, The short answer is yes, because it's always just a dumb matter of political expedience, and that there is no anticipated future. So the political decisions are not made like, oh, what if we don't? What if we? I think it's obvious all of us politicians are not thinking about anything beyond their political survival that day. So you have to look at the SPR releases along with every other ridiculous political event as nothing more than a political expedience in the short term. And I personally, actually, it's only when oil really starts to bump 125, 150 that it really starts to matter. So this is like directionally alarming, and rate of change is too high, obviously. So like lots of red flags, but still the absolute level, it's okay. But it's got a lot of velocity in the wrong direction if you are an economic optimist of the political persuasion and you're an incumbent.
Well, the other thing is, too, the SPR is a drop in the bucket as far as...
It's all the marginal barrel, right? Marginal barrel. The whole world is the marginal barrel.
Yeah, we're talking about a very, very, very small amount of oil as far as U.S. actual energy use and needs, and shale production is at the highest it's been in ages.
That's why I say the whole thing is like it's rhetoric. The use of the SPR is a rhetorical event. It's not an economic event.
I completely agree. I mean, this is a slight release valve in an emergency for the course of maybe a week or two kind of thing. This is not anything that presents any meaningful balance altering thing in the markets. Shale output is booming again. This seems like a matter of time.
People think that the Biden administration's decision to unload the SPR was a political one, and they're absolutely right, because the SPR itself was a political creation.
Yes.
But I would say the SPR is always political, not just when Biden does it, but when Obama.
Well, of course.
Of course
Trump
it is.
Does it? I mean, it's come on. It's pure theatrics.
It's like
pure
the
theatrics.
debt ceiling. Just like the debt ceiling.
That's a different kind of kabuki theater, but
both bullshit.
But both theater.
But the SPR is created in effectively the beginning of the end of 1974, when the U.S. becomes a signatory to the International Energy Agency, which effectively mandates that a country shouldn't have less than 90 days of oil inventory relative to their overall import levels. And it's been used over the past 50 years now to effectively keep gas prices lower. So the Biden administration doing so at a time when global supplies are dwindling, both because of production and because of sanctions on Russia, which you may say to yourself, well, we are the ones who sanctioned Russia. We're the one who took their inventory off the market. So let's fix this by letting them back on. Another story for another time. But the SPR itself...
Can I interject? I'm sorry.
Yes, you may.
The Russian oil is still on the market.
Very much so.
That's the
Just not coming directly to us.
They just don't go. So the reason the whole thing is a total crock of baloney.
That's why I say kabuki theater.
These are very benign and kind characterizations of an obscene act of economic exploitation, deception, espionage, and annihilation for many, especially if you're like a German diesel buyer. Because the actual flow of actual oil has more or less been uninterrupted. It's just been price adjusted and reflagged offshore in the Persian Gulf in the middle of the night by putting the transponder off the one tanker and then running a decoy and then running a siphon in the middle of the night. I mean, listen, the oil's moving. That's the reason I find this whole war thing so irritating is you have a repricing of an asset purely based on the perception that future supplies could be interrupted, but while the actual flow of the commodity is effectively the same.
Not only that, I mean, there's
disgusting.
carve-outs in the sanctions for the energy. So, I mean, and grains. So it's like this whole sanctions regime was never really even aimed at oil or at grains because everybody collectively said, well, look, nobody needs to freeze and starve because the Russians want to invade Ukraine. So there were always carve-outs here. Of course there were.
But there was a repricing such that if you're a German diesel buyer or a British heating oil buyer or an Italian, commercial, a restaurant operator, you suddenly pay triple for your heat, industrial fuel sourcing, whatever, at any scale, but the actual availability of the commodity is unchanged.
Well,
and that is screwed up.
Yeah, and if you looked at oil before the Saudis started their unilateral cutting that people seem to be believing in for whatever reason, even though, as I've maintained, there's absolutely no reason to believe it's going to work. It's never worked before in the modern era, obviously not the 1970s when it did. But if you looked at where crude oil, nat gas, like what their performance looked like from the start of the war as of, let's say, 2 months ago, before the Saudis started to talk, let's say 4 months ago, pre the original July Saudi move, it was dramatically lower.
Which
nat gas was dramatically
so the market reflected actual supply.
That's right. That's right. And so, and of course, just like you read the WASDE report about grain, you can read the EIA on oil, and all of the reporting from all of officialdom in the U.S., the statisticians that actually populate these agencies, all of them are saying, so there's a lot of marginal Black Sea supply of all of this stuff that's coming through, which has sort of fed my suspicion that what the Russians are basically doing is flooding the market with anything that has loopholes and sanctions, because of course they need market share. They don't want to lose it as a consequence of this war. They do need money from somewhere.
But more than that, the first night of the war in the Middle East, they were like, oh, there's a new business where you meet the Russian ships offshore in the middle of the night and reflag them.
Yeah.
But the oil still moves. Just there's an additional cost.
Yeah.
Or the split basically goes in the direction of the third party flag. The Russians take a hit, but the oil moves.
Sure.
From day one, from the February 22nd, like same day.
Sure. I mean, that might be to some extent, to your point, why the market seems to be caring about this Saudi thing, because maybe they don't so much care that Saudis can really do anything on production, because the moment they do, their fellow OPEC members are going to undercut them like they seem to have done every single time from 2014 onward. But if it signals also that maybe there's going to be less of this, let's call it,
gray market
window washing of Russian supply, then maybe that's a real supply shock.
Well, I want to bring this conversation to a slightly different direction because to me, it validates what we've seen here in energy markets, validates a perspective I've had for a few years, which is the green energy transition means higher oil prices. Because we have really fundamentally dropped the ball when it comes to creating a stepping stone. Believe in green energy, don't believe in green energy. That's not the point of what I'm getting at. The point is that there seems to be a concerted effort by global leadership in the West to transition away from fossil fuels, to move towards renewables, hydro, solar, wind, electric, right? Alternative forms of energy generation. And perhaps one of the safest and underappreciated forms of energy out there, nuclear, we just don't have the capacity to build in quick order. So as we see these production cuts come into play, as global energy demand rises, you have this bottleneck effect going on right now where lower supply and higher demand means higher prices for existing fossil fuels in the very short-term window. Is this going to be one of the legacies of the green transition, Dylan, that we'll have to deal with uncomfortable years of higher oil prices?
Yeah, I mean, there's many people who are much more expert in the domain of energy than any of the three of us who are anticipating the greatest fossil fuel price boom in history. I mean, look no further than Kazakhstan, where you saw sort of a global movement against coal-fired whatever, the coal-fired power generation or coal-fired whatever, steel plants. And Kazakhstan was like, okay, we'll sell as much coal as you would like at now 2, 3, 4, 5 times the previous price. And I think that that's the future of all fossil fuels, is that between now and 100 years from now, goes to $1,000 a barrel as we transition away from it, right? But I mean, there's no better time to own fossil fuels in the next 30 years until they're worthless. It goes from 0 to a billion to 0. Not 0, but 100.
Well, especially with deglobalization going on and that crimping supplies of all the materials you need to build the green energy transition and making all of that much more expensive, nobody's getting off fossil fuels anytime soon. Especially since the kind of renewables that work from place to place vary tremendously. Wind and hydro probably more effective in Europe, solar probably more effective in the US, et cetera, et cetera. There is no single green transition. There is no single green technology, and all of it requires a tremendous amount of inputs, the trade in which is only going to be more hampered, not less, by the trade system getting more siloed. So nobody's going anywhere quickly on this, it would seem.
ExxonMobil closing at an all-time high today, a stock that we really don't talk about to substantiate the whole coal perspective. This is HCC, Warrior Met Coal. It's a coal production company. They're moving up here, which if you scroll back long enough on your charts for their stock price, not quite at an all-time high yet, but we are certainly moving up to levels that we haven't seen going back since the stock price was discontinued briefly, at least on our chart, going back
That's
to 2015.
That's a nice gap right there.
But the point is that right now...
That gap lower might cause some people at a meeting to ask questions before assigning meaningful assets.
We talk from a technical perspective about how gaps usually get filled. Well, it's been nearly a decade in the making, so we'll see what happens. But the point is that fossil fuels right now are in high demand. Global demand for energy is at all-time highs. Supplies continue to be cut. And in the United States, we just had alarming data this week that not only are inventories being drawn down, but the checkpoint, the choke point in Cushing, Oklahoma, which is a key hub for WTI, is now looking at some of the lowest inventory levels that we've seen over the past decade. So does this mean more production in the U.S. is going to come online soon? Well, you got to think that $100 a barrel is probably going to draw in some people. I've mentioned this a few times in the past week on Futures Power Hour, but oil among all the commodities, same thing for natural gas, they tend to show signs of autocorrelation where they are a bit stochastic. When oil prices rise, it causes demand destruction and invites a new production. And when oil prices fall, it invites a new demand and lower production. And so you don't really see that much movement, which is why there are some economists out there, the people in their ivory towers with their $300,000 a year salary saying, well, if you adjust the price of oil or a gallon of gas for inflation, it's really not that high right now. But that's not how the average person thinks of it. In any event, I think that we're going to see further drawdowns in inventories moving forward, plain and simple. Whether OPEC, to Ilya's chagrin, is able to actually realize their stated production cuts because of things like greed, what have you, is another story. But oil prices here, fresh yearly high, fresh 52-week high. And I bring this up for another reason, because we see that bond yields continue to push up today. I couldn't help but notice that the correlation between, say, ZB and CL is now at a negative 0.77 on a 1-month rolling basis. The correlation between crude and ZN right now is negative 0.76 on a 1-month rolling basis. And the correlation between CL and ES, that has changed dramatically here. On Wednesday, September 20th, a week ago, the correlation was 0.59. Now it's negative 0.52. So oil increasingly becoming a problem for bonds and stocks, and oil just broke out higher to the upside today. That could be a bad omen for how trading breaks down in the future. Ilya, we haven't talked much about ES here on the show this far. I brought up the continuous contract earlier today, and I tweeted this out. I don't know what we call that now. Posted it. That sounds lame. But off the continuous
I'm going to keep
contract,
using tweeted because I'm stubborn.
I X/tweeted it. It's like,
because you know what? I don't want to tell people I'm on X because that has other connotations, right?
X, formerly known as Twitter. So I X'd formerly known as tweeted the following statement.
That's a mouthful. The lows that we have here in October last year, in March of this year, we bump into that trend line today. Really, no matter how you draw it, I know some people say, "Oh, you just make the trend line thicker, and then you'll find enough support."
Not some people.
Just you. But in any event, this is kind of
using sloped lines.
This is kind of the point where no matter how you slice it, it's time for equity market bulls to put up or shut up, because from a technical perspective, this market's starting to look heavier and heavier and heavier. And if bond yields keep going up, if oil prices keep going up, we may have more of a problem on our hands. Dylan, you started off the show, though, talking about more or less a continuation of our thoughts at the end of yesterday about labor, about the general shape of the workforce and these generational shifts that are going on. Perhaps it's best we pick up the thread from there. You seem to have more on your mind. The floor is yours.
Well, just let's kind of go with the sort of this, Illy's is a macro fellow. I skew kind of macro in my political economic perspectives. Let's go with $200 barrels for oil. Let's go with $10 a gallon for a gallon of gas. Let's go with 7.5% for a mortgage. And let's go with a tight labor market and limited housing supply for the next 10 years. Is that a good world or a bad world? Now, I would argue, if that could be a good world if it's predictable. If you know, if it's stability that is actually more valuable than the price level. And the previous incarnation was extreme and irrational, 0% for a decade, and what all the statistics. I would say 7.5%, a couple $100 for a barrel, $10 for a gallon of gas in the era of the EV. That might be the recipe for prosperity. So the irony might be that sort of higher base levels of cost of money, cost of energy, but more stable levels may actually fuel growth, bizarrely, because it'll sort of incentivize the transition, incentivize the EV, incentivize the work from home or the AI or all the, whatever that path is going to be, that the future is incentivized by a higher cost of the present.
Ilya?
I mean, I don't think there is a 10-year arc to something like that necessarily, because it would choke off growth fast enough that you'd get rate cuts and you'd get some relief. And I think that's what the markets are kind of aiming at in sort of starting to price in some kind of an easing cycle next year, basically saying we're going to turn the screws tight enough and the lag effects will have a chance to do their thing to where the pain will become sufficient enough that there will be some relief. The spirit of the proposition that we're looking at structurally higher inflation and the trend is toward higher inflation, which means that the trend is toward higher structural rates, lower structural growth, more structural bargaining power for labor, and that all of this is a forcing function to a lot of the disconnects that have emerged over the past 40 years as a consequence of low rates and basically owners of equity and owners of financial assets kind of dominating to a skewed, historically speaking, degree the entire system, and that process kind of starting to normalize now. I think having a decade plus, maybe longer arc for all of that makes perfect sense. I think that's exactly what is about to happen. But
which you wear with equity prices, which is sort of so let's assume, higher energy costs, higher money costs, but also higher rate of change, a higher rate of efficiency, higher rate of productivity, higher rate of connectivity, higher rate of efficiency. So I can, for all your higher energy costs or money costs, I can throw some optimizations back at you.
Sure.
And better, maybe even mild redistribution in labor's favor, all that.
Yeah.
Which leaves your equity trend where? Because equity trends in the 70s were terrible.
Yeah. No, I think there's a lot to give back in asset prices because they are fundamentally sort of existing on the basis or on a bedrock of assumptions that are not unreasonable assumptions that have held for 40 years. The thing is, they don't hold anymore, and they're probably not going to hold going forward. Assumptions that we're in the middle of a 40-year decline in interest rates, in inflation, in the price of money all around, in globalization becoming ever deeper, in supply chains becoming ever more global, in shipping becoming ever more predictable because it is protected by American military might. All of that is going away. I think the most interesting aspect of what's going to happen in the equity space as a consequence of all of this is greater divergence in how equity markets behave across geographies. So right now, the U.S. market, you might as well be looking at a global stock direction. The S&P and let's say the MSCI World Stock Index might as well be exactly the same thing. I think you're going to get more divergence because different geographies are going to be better versus worse at handling all of this, which goes to our point that the U.S. and its equity markets and its companies, which will become increasingly more focused on the kind of the friendly region for those companies with nearshoring and friendshoring and reshoring and all of this, and the customer base shifting closer. I think all of that speaks to those companies probably doing better than, let's say, European counterparts, certainly better than Chinese counterparts, a lot better than much of East and Southeast Asia. So I think more divergence.
But just to take it to the rubber in the road, because we can listen,
yeah,
we can jabber around the future of the world till we're blue in the face.
Sure.
But it seems to be that your long dollar position, like when you talk about your various scenarios of the future, Ilias, I hear higher dollar.
Yes, very much so.
I mean, look at that chart. If you're an optimist for a currency, what do you want? I mean, that's a good...
I mean, so we were talking about the dollar basing at that little gray box there. I certainly was an absolute broken record on this subject going, watch that support. It's basing. This is a pullback in a trend higher. It broke out last year. It's going upward. Unless you break through that back down, what you have is a basing that will precede continuation, at least from a purely technical perspective, unless shown otherwise. And what we're very clearly seeing here is, yes, indeed, we took months and months and months to base, but where are we going? We've very clearly broken out. I think we're looking at probably some friction at the former highs, but structurally, I think this is an uptrend that isn't going anywhere.
The dollar seems really well footed on a day like today where
not mad at it.
The news abroad just really can't be as bad as it is right now. I mean, we haven't seen an escalation in Eastern Europe per se, but news about Evergrande overnight, the Chinese property market developer failing to pay its bonds. We see that the PBOC is stepping up support to bring stability to the market. European growth is still just an absolute mess. Any news that you're hearing coming from across the pond remains weak at best. That does create an island effect.
Came out overnight. They were, to put it mildly, eye-watering. The credit impulse to GDP is the most negative it's been since early 2010. So worse than the Eurozone debt crisis, on par with sort of latter overhang from the financial crisis. So very, very tight, very profound squeeze from the ECB's tightening on credit conditions in the euro area.
And it's not good for the euro, which continues to fall. If UUP is running higher, then the largest component of the dollar index, 6E, is probably falling apart. And indeed it is.
11 consecutive weeks if we close down this week. I know these factoids because I'm going to be talking about the euro on Macro Money right after this because we have German CPI and Eurozone CPI immediately ahead of us. And so I have some fun little quote this stats for you. The only time that we've had anything like this was 97. And we've never had a longer than 11 weeks run of losses.
When you say 1997, you mean the implied rates based on the Deutschmark and franc
That's
and
right.
Italian lira?
That's right. Because at that point, we didn't even have a year.
Right.
That's right.
Well, that was in the messy years in the exchange rate mechanism, too.
That's right.
What a big mistake that was.
We had the ECU, the European Currency Unit, and the snake.
Well, you see the euro here, it briefly ticks the lows that we've seen in all of 2023, and you might say there's a little bit of buying interest in there, but my goodness, watch out below if we do break through. And then we begin to have those fun conversations about what a move down the parity looks like. Stocks typically don't like a stronger U.S. dollar, although I would make two arguments given the level of U.S. energy exports these days. The dollar is behaving more like a petrocurrency. I don't think it's any coincidence that the dollar's been rising in an environment where oil's been doing well. The other is that there was a study a few years ago, last year or 2021, doesn't matter. Kansas City Fed put out, or was it the St. Louis Fed? It doesn't matter either. One of the two central bank regional banks put out a study saying, does a strong dollar hurt big corporations? And they arrived at the conclusion that it actually really doesn't matter for corporate earnings because 95% of what we import from abroad, it's billed in US dollars directly anyhow. So the dollar goes up, dollar goes down. You know, when we see something's $19.99 and we're importing it from the UK or Germany or from China, it's $19.99, period, end of story. Those are locked in prices for a lot of these contracts. So to think that the strong dollar is going to have a negative impact on corporate earnings, I'm sure we will hear a lot of corporations complain about it in upcoming earnings reports. Whether or not that's a legitimate complaint is another story unto itself. But Dylan, this is a problem heading into the winter months.
What I was just thinking, listening to you was, you know, if my thesis that fossil fuels are, you know, a generational order of magnitude higher over the next 30 years, let's say, because of the sort of sunsetting of the resource over the next 100 years, one way or the other, to nuclear, to sustainable, to the apocalypse, whatever it may be. But it's something over the next 100 years will change. I do wonder whether the strengthening of the US dollar, which could easily sustain as well, by the way, certainly for years, if not decades, is a prelude to the final sort of resettling of some fantasy global currency that it's some number of decades in the future, that it won't be the BRICS, it won't be an RMB basket, but at some point, some way, somehow, crypto, digital, decades, that the dollar and the oil are almost similar in that they're the sort of the final reign of an aging king, if you will, that may last for a decade or two, or at least a decade.
I would argue that crypto is doing more to cement U.S. dollar dominance than replacing the dollar as a medium of exchange than anything else, because all of a sudden you have these people in foreign countries that can convert their money out of their local currency during times of turbulence. And if you're buying Bitcoin
or Tether, right? You're doing it in dollar terms. And so inadvertently, you know, as dollar demand by way of crypto.
Exactly. Yes. And so, I mean, that's one of my, you know, tinfoil hat conspiracies that I like to wear. Bitcoin isn't replacing the dollar. Crypto's not replacing the dollar. It's actually helping prop up the dollar as the dominant global currency. And if that adoption continues and we see energy prices continue to move the way that they are, what is it going to do? It's just going to invite more people into the US dollar, which, as Brent Johnson, who's been previously a guest here on Tasty Live, there was an interview that former show host Vic Jones and I did with him a little while back, I'd say last September or October. we can share the link for that once more. The dollar is drinking the world's milkshake. Right back to the top of the show. See how we did that? But the dollar is sucking up all of the liquidity from everywhere else around the world. And now, given the United States' place as a major energy exporter, coupled with the rise of crypto, it's only starting to do that at a faster pace, as it were. So dollar dominance is here to stay, folks. And I know that undermines or upsets some people in the audience because they think that the U.S. is horribly mismanaged. That may be the case, but when you're the world's reserve currency, you're afforded certain privileges that don't necessarily fit into a neat little box.
Well, and here's the thing.
That's a nice way to say it. It's more like when you're the reserve's currency, everyone's your.
Well, this is a family show, Dylan, so I don't talk like
that.
Sorry.
I mean, the sentiment is certainly apropos. I mean, when you are the reserve currency and there is no alternative.
No alternative.
No alternative. What are you going to do? Now,
they prove that in 8 and 9. They're like, watch this. This. Like, we'll run 30 trillion and the dollar will still get stronger. My apologies, Chris, for the inappropriate social commentary there.
don't even worry about it.
I like recognize it's a family program. But sometimes it's an efficient means of communication. It's a good bumper sticker.
It's more like the Addams family than anything else. So,
I mean, for me to believe, and I do believe that things invariably come to an end, and there are transitions in things. I mean, of course, the question that I would need answered to believe that the dollar is not necessarily going to end its dominance eventually. Again, all things invariably end. The question is when and how. For me to sort of have any kind of sense of urgency or even forecastability in that conversation, I would need to see what the alternative is. And today, there isn't one, or even the prospect of one, or anything that smells like one.
Not to mention, I think Chris is dead right, where if you have, rubles or rupees or RMB or Brazilian real, and you can get it into even crypto, a tethered USDC, forget Bitcoin.
Yeah.
You will.
Sure.
The crypto creates consequential marginal dollar demand.
Absolutely.
Yeah.
I'm glad you agree with. I'm agreeing with you. Agreeing with me, Dylan.
But so then, okay, so we're the big agreement party. That's great. But as we've discussed many a time, being in agreement, that's lovely. Being right, also lovely. But you can be in agreement and right and still lose all of your money.
100%.
Put your right opinion. It's like
not in Overtime's case. Ilya's been standing upon high for months and months and months, saying, folks, the dollar's going to go on a tear. Just wait. Just wait.
What's the mechanism, Ilya? Is that call options, futures? What's the tech?
Futures and spot. Futures and spot, mostly. It's much easier to do crosses in spot sometimes, especially when you're looking at things like, let's say, the Kiwi dollar, where you might not have a great futures option. But
like the one thing I can't pull up on the platform. Good. Yeah.
Well, there's not a good futures option. There you go. So it's been a collection of just building a basket of long dollar exposure. So short things like 6E, 6B, 6A, 6C, all of that. So directional accumulation of long dollar exposure against pound, euro, Aussie, CAD, a little Kiwi. I've been in and out of CAD. That's been the one that's been a little bit trickier, but I've actually bought some just overnight here because I think maybe it's time for it to have a little bit of a catch up higher. To your point, Dylan, I think it's important not to confuse what we're talking about, which is a very kind of big picture thing, with immediate, like, you should go buy it now. Because if you look at,
of course that. I was more just to where do you find liquid instruments and how do you manifest the directionality? To run out and buy anything now is almost always a fool's errand unless you have material inside information.
well, and if you look at even that 6E chart, I mean, we're talking about 11 weeks of consecutive gains. The only other time that's happened is with the implied euro, to Chris's point, not even the actual one. So this, at a time when we're sitting squarely at the lows of the year and testing that as a support level, seems like something that probably doesn't have very good risk reward until it's either bounced some and given a higher place to sell or has broken through. I think we're going to get this German and Eurozone CPI data this week, and it's not going to change anything. It's supposed to see inflation.
As my friend Tom would say, at this particular juncture, it doesn't have the best pot odds.
No. So it's not going to change anything here. The ECB is not expected to hike anymore. We're going to get softer inflation for mainly base effect reasons. So like the influence of the Germans' public transportation subsidy will fall out of the year-on-year calculation this time. So we're going to have lower CPI numbers. Are they going to change anything for the ECB? No, they're already not expected to do anything else. So to that extent, there might be a little bit of relief in the euro here episodically. If it bounces and then stalls and then offers an entry opportunity, I'll be adding to my shorts. I'm not going to be certainly betting on a direction change. I don't think it's coming. But we might be looking at some episodic euro strength here just because we've run out of immediate fodder to throw on the bearish fire.
So just profit taking effectively because people are now seeing us back at the yearly lows, and then they want to, we're getting to the quarter end, right? There are going to be rebalancing flows here over the next few days.
Sure.
Not just end of month, but end of quarter. So something to consider if there's a bounce, that the trend remains predominantly to the downside. Yields continue to point higher, which finally became a problem for something that I have been watching and waiting and very hopeful about. And boy, there are those days where sometimes I say to myself, Chris, your macro view, paralysis by analysis. Why can't you act sooner? Like the June 30th FOMC meeting when I was really short the NASDAQ and it was doing really, really well. And I, made this joke before. I'm sitting in a position that's up a few $1,000s. And by the time the day ends, I think I make $83 from the trade, right? Yeah. Because I'm just too slow. Like I'm thinking about what Powell's saying. What does this mean? It just cluttering. But then there's gold, which then I think my macro monkey brain for saying thanks for taking your time. Because when we saw this move higher last week, you and I were speaking, said, let's see if we can find some continuation here and get a confirmation that this is a breakout. I'm looking at this 2020
high. It needed that range high break. And we said, well, as long as it's underneath that range high, let's give it a second.
And then the next day we closed back within the channel. And we said, okay, well, false breakout, return to the other side of the consolidation. That means a move to the lows near 1900, 1910 or so. We'll see what happens.
Yeah.
It was worse than that. $1890.90 per ounce here on gold. Yeah. Is this just capitulation of people looking at the higher yields, the stronger dollar, and saying, you know what, like I've been holding on to this. It's the end of the quarter. I'm going to take my ball and go home for a little bit. Is the overall thesis that I've been spouting, I'm not going to attach your name to this failed idea per se just yet. But the overall thesis that I've had is it's not failed yet. And this is a discount. I should be looking at this as a gift for my long gold exposure, that I've yet to put on, that I really do want to put on, but I've just been, for whatever reason, waiting for some technical evidence that hasn't come together. We're almost near the lows for the year.
Right.
Is this the time to start taking my shot?
I mean, here's what I'll tell you here. I don't like
Make me feel bad, Dr. Spivak.
I don't like to catch a falling knife. I don't like to try to pick a bottom. We had, in the spirit of this being a family show, I will selectively quote this. but a former colleague of ours was a pure technician, couldn't care less about anything except technicals. He used to say, you know what happens when you try to pick a bottom? You get a bunch of things you don't want in your hand. So what the danger here for me is we're right near that former low. And if you're trying to sell into this, the risk reward is awful. You just don't have a lot of room into support. Meanwhile, you have much more room into resistance above the current price level. So even at that former range bottom that we've just cracked through today, above 1900. So I look at this and I say, well, the risk reward to going short is awful. At the same time, the risk of going long is you have no confirmation that you actually are going to hold that support. And if you always held support, markets would be in a perpetual range. So you may not hold it. It may crack. So for me, this is not a tradable thing yet. It's if you find support here and there's some indication that you're turning a corner at it, that's a long. If you break through and you close underneath the low, at least let's say on an 8-hour basis, but ideally a daily basis, maybe you can nibble on a short, maybe that's a breakout. I don't think we're going to have a breakout for what it's worth, because I think that what we're seeing in the yield curve is a bear steepener. It's the long end going higher and the front end holding, which is recessionary in my mind. And so I think there's a bunch of anticipation of lower rates in the nearer term. But
let me ask you the simplest question, Ilya, which is, we're running a risk-off week, we'll call it, since last week's Fed meeting.
Yeah.
And gold's doing this. Gold's a risk-off asset.
In certain circumstances.
What's going on?
In certain circumstances. I mean,
okay, that's fine. But I'm just saying, we're running risk-off. Dollar's stronger.
Yeah.
And I got gold going the wrong way.
Yeah. Yeah. I mean, I think that gold was holding up as well as it was until today, with all of these factors that have been happening for a few weeks now, right? We've been in this risk-off market for longer than a day. Gold decided to respond today. It's been holding up pretty well otherwise in a rising interest rate.
I could argue gold should be stronger in a risk-off market.
I would agree. But it's only stronger in a risk-off environment if that strength brings with it if that risk-off environment, I should say, brings with it lower yields. Why does gold tend to strengthen in a risk-off environment? Because capital goes to bonds, bonds go up, yields come down, gold yields nothing, so the opportunity cost to own it is reduced.
The spread tightens and it becomes marginally more attractive.
And the attraction of a real terms store of value becomes that much more attractive if nominal yields come down. That isn't what we're seeing here. We're seeing the risk aversion seemingly precipitated by higher rates. This is much more the story of all of last year. What did we see last year? Higher rates meant lower stocks and lower gold. All of last year. So it wasn't much of a risk-off asset then when the motivator for the risk-off were rate hikes and yields going higher. So if the story begins with yields going higher, that's not an environment in which gold has that risk-off quality. I would argue it should regain that risk-off quality as we start to think about rate cuts, because the dynamics of the yield curve are increasingly recessionary in how they look.
Which brings us to Chris's tentative and as yet unexecuted long gold position.
Yes, eventually, though I would argue this is not the time to do that. I would argue it's premature, that I would wait here.
Well, Ilya, as you know, my plan was always to jump out of XOP and XLE and use the proceeds to fund that gold position, and I haven't done so yet, which is part of the reason why I haven't executed the trade.
A great example, by the way, of being macro wrong and money right.
Well,
which is what we all hope for, really. Forget the macro. Let's just be money right.
Yeah. Do you want to be right or make money? Right. Like,
yeah.
Hi, bank.
We want to be money right. We want to be
hi, bank. I was right. I'm going to use the amount of rights I got this week in the market to pay for my mortgage. That doesn't work.
I've been macro right with my call spreads, but all in money wrong.
It happens from time to time.
Wrong size. Still playing. I'm still attending the event, mind you, but.
I mean, I was struggling with my dollar long thesis for much of the first half of this year, but nibbling very, very, very lightly on that exposure, losing on a lot of those trades, but very, very modestly, basically saying, oh, not the time yet. Time to cut it off. Oh, not the time yet again. Time to cut it off. And just keeping those losses really small, waiting for this, essentially.
So as we wind down this show, two things come to mind here to kind of wrap this up. One, the markets did rally later this afternoon because of a continuing resolution that could be passed. I have a feeling we're going to be going through a start-stop process here with shutdowns and whatnot over the next several months. And it's kind of a joke to me that the market got all jazzed up on a continuing resolution because it means that we just kicked the can down the road. Government shutdown starts this weekend. If we don't get a deal signed, we'll see how this all shakes out. There certainly seems to be politics in play. Speaker McCarthy wants to hold on to his seat, so he can't use Democrats to help pass a bill. Good luck with that. We'll see how it all plays out. The other thing is that I saw a report yesterday showing that the rate of homelessness among boomers is now at the highest level since the Great Depression. So first, a joke. Boomers weren't alive during the Great Depression, so who cares about a data point like that? But the jokes aside, this is a natural endpoint for decisions made over generations, over decades by U.S. policymakers to sign trade deals, to allow corporations to put jobs and money overseas, to underinvest in our infrastructure, in our healthcare, in our housing. And so anyone who's walking around with a shocked Pikachu face that, oh my goodness, how could we let this happen? Well, we did let it happen. These are choices we made. We made these choices intentionally. No one came in the night and took these jobs from us or cut apart the fabric of our social safety net.
Yeah, but the people that made the decisions are
not
the
people we elected.
No. Actually, it was the multinationals paying the people we elected because it was in JP Morgan's interest. It was in Nike's interest. It was in Apple's interest. My point is it's the people who benefited and made the decisions are not the ones who pay the price. So
absolutely agree. Absolutely agree. But corporations don't vote, people do. At the end of the day, they may use their lobbying money to get people in place to push across certain agendas.
Corporations decide who the candidates are that you get to vote on.
Perhaps that may be the case. But in any event, no one should be surprised when the data gets worse because we've allowed it to happen. And if you have a problem with it, get out there and do something about it. In any event, this overtime is out of time. He's been Ilya Spivak. He's also been Dylan Ratigan. I've been Chris Vecchio. We'll be back tomorrow after a quick 23-hour break. Until then, good luck trading. Up next, Macro Money with Ilya Spivak.
You there, folks?